Dreaming of an early retirement? What if I told you that dividends could be your ticket to making it a reality? Hi, I'm Kenney, wealth advisor with the Noble Group. Today we'll dive into how dividend investing, whether you start young or later in life, can help you retire on your terms. Let's explore the strategies and important considerations. What are dividends? Dividends are a portion of a company's profits paid out to shareholders, often on a quarterly basis. Think of it as a reward for your investment in the company. Not all companies pay dividends, but those that do often aim to provide a consistent income to their investors. So can dividends help you retire early? To answer that question, we need to look at two phases of investing. First is the pre-retirement or accumulation phase. During the accumulation phase, the goal of a dividend portfolio is compounded growth through reinvesting dividends. Reinvesting dividends, using them to buy more shares of the stock that paid the dividend, has long been a cornerstone of long-term investment strategies. Famous investors such as Warren Buffett, Benjamin Graham champion this value-oriented strategy. During the accumulation phase, this approach compounds growth over time by accumulating shares systematically through dollar cost averaging. Over time, your investments generate more income, which you can later use for living expenses. The second phase is known as the retirement or decumulation phase. In the decumulation phase of retirement, the focus shifts from growing your portfolio to generating a sustainable income. There are four main reasons to utilize dividends in retirement. The first is passive income. Instead of reinvesting dividends, you use them to cover living expenses, providing a reliable stream of passive income. Depending on your portfolio's value, yield, and income needs, dividends can either supplement other income sources or fully support your lifestyle. Meanwhile, the underlying investments retain their growth potential, helping to preserve and extend the longevity of your retirement funds. The second is financial stability. Many dividend-paying companies are well established and financially stable, like blue chip stocks. The long-term success of these companies can provide an added sense of security in your retirement income plan. The third is flexibility. Dividend income can give you the flexibility to supplement other income sources, such as part-time work or rental income, in early retirement. If you decide to go back to work full-time, you can switch back to dividend reinvestment. And the final way is through tax benefits. Qualified dividends are often taxed at a lower rate than ordinary income, which can make them a tax-efficient way to generate income in retirement. A question we get asked often is, how low would my tax rate be when I retire if my portfolio consisted primarily of qualified dividends? To answer that, let's review the 2025 capital gains tax brackets. Qualified dividends are taxed based on capital gains rates, which means they can be entirely tax-free if your taxable income falls under certain thresholds. For single filers, this means taxable income under $48,350, and for those married filing joint under $96,700. With proper planning, it's possible to live on a 0% tax rate in retirement. Stay tuned, we'll show you an example of how this works later in the video. So, is it possible to utilize dividends in your retirement strategy? Absolutely. Let's look at the steps to start investing in dividend-paying assets. Then we'll review a couple of examples to show you how you could utilize the dividend strategy to optimize income and reduce your tax liability. Step 1. Focus on diversifying your investments. By investing in companies across various industries and sectors, you reduce the risk of any single area negatively impacting your portfolio. Diversification helps balance your returns, as declines in one sector can be offset by gains in another, creating a more stable foundation for long-term growth and income. Step 2, balance yield and stability. While high-yield stocks can be appealing for the income they provide, they often come with higher risks such as volatility or financial instability within the company. To mitigate this, pair high-yield investments with stable, lower-yielding options such as blue chip stocks or dividend aristocrats. This balance helps ensure a steady income while protecting your portfolio from excessive risk, creating a more resilient and sustainable investment plan. Step 3, pick the right account type. While holding dividend-paying stocks in IRAs will help maintain a lower tax bracket in the accumulation phase, IRAs are not the best account type for dividend investing in retirement from a tax perspective. If your focus is to use dividends in retirement, look at using taxable and Roth IRA accounts during the accumulation phase. This will give you better control of your taxes in retirement. And lastly, focus on dividend growth. Look for companies with a history of increasing their dividends. This can help your income keep pace with inflation. An example is the S&P 500 Dividend Aristocrats, which is a stock market index composed of companies in the S&P 500 that have increased their dividends in each of the past 25 consecutive years. Now let's look at a client example of how utilizing a dividend portfolio in retirement can optimize income and reduce your tax liability. In this example, our clients, Jim and Sally, are retiring at age 60 and need $120,000 per year to cover their living expenses in retirement. One of their primary goals is to generate tax-efficient income during this phase. We've modeled two strategies to meet their income needs. The first strategy involves taking a full distribution from their IRA to cover both taxes and their required income. The second strategy combines dividends with IRA distributions to optimize their tax situation. Additionally, Jim and Sally will utilize the standard deduction, which for a married couple in 2025 is $30,000. When using IRAs for income, every dollar withdrawn is taxed at ordinary income rates. If Jim and Sally rely solely on their IRA to fully fund their $120,000 living expenses, they'll also need to withdraw additional funds to cover the taxes on those distributions. In the second scenario, however, we reduce the IRA distribution to $30,000, which is offset by their $30,000 standard deduction. This effectively eliminates any taxable income from the IRA. The remaining $90,000 comes from qualified dividends, which fall below the taxable income threshold of $96,700, allowing them to maintain a 0% tax rate. Now let's review the tax reports we prepared for both scenarios. As you can see in this tax report, under the first scenario, Jim and Sally need to withdraw an additional $12,344 from their IRA to cover the taxes on their distributions. This means they must take out a total of $132,344 to net $120,000 for their living expenses. This approach not only increases their taxable income, but also reduces the longevity of their retirement savings. Now let's examine the second scenario where we incorporate dividends alongside the IRA distribution to create a more tax-efficient strategy. With a $30,000 standard deduction, we can completely offset the $30,000 of taxable income from the IRA, making it tax-free. When we add in $90,000 in qualified dividends, these are also taxed at 0% since the combined taxable income remains under the $96,700 threshold for 0% capital gains rate. This means Jim and Sally can generate $120,000 in annual income while paying no federal income taxes, a highly tax-efficient strategy that maximizes their resources and preserves their retirement savings. As you can see, using dividends in retirement can be a powerful strategy for reducing taxable income. And while dividends offer many advantages for retirement, it's important to be mindful of the potential challenges they may present. First, take market volatility into account. Stock prices naturally fluctuate due to economic conditions, company performance, and broader market trends, which can directly affect your portfolio's overall value. While short-term volatility is common, it's important to focus on your long-term goals and avoid making emotional decisions based on temporary market swings. Additionally, be mindful of the potential for dividend cuts. While dividends can provide a steady income stream, they are never guaranteed. Companies experiencing financial difficulties, declining profits, or economic pressures may choose to reduce or even eliminate their dividend payments to preserve cash flow. This can impact your income and overall investment strategy, so it's important to monitor the financial health of the companies you invest in and diversify your portfolio to reduce reliance on any single source of dividends. And always remember that inflation poses a constant risk to your investment strategy. Over time, rising prices can erode the purchasing power of your income, including dividends. If the companies you invest in do not consistently grow their dividends to keep pace with inflation, the real value of your returns will decline. This makes it essential to focus on dividend-paying stocks with a strong history of increasing payouts, ensuring your income can maintain its purchasing power as living costs rise. Dividends can be a cornerstone of your early retirement strategy, providing a steady income stream while allowing your investments to continue growing. However, careful planning and a well-diversified portfolio are essential to managing risk like market volatility, inflation, and potential dividend cuts. If you're curious about how to structure a dividend-focused portfolio or want to explore this strategy further, let's connect. Our team at the Noble Group is here to help you live your retirement on your terms. Thanks for watching.